Good morning, my beloved clients. Out on a hike this morning and just thinking about you guys. I wanted to do this video. So what I wanted to talk to you about was the market price of a stock. And to really understand what determines the market price of a stock. And so when you see the price of a stock throughout the day or at the end of the day, that represents the most recent closing price of the most recent transaction in that stock. That's the only thing that represents that the most recent trade was executed at that price. And so that means that at that price, somebody bought it and somebody sold it. So it doesn't necessarily represent the value of that company or the market's opinion of that company. It really only represents the opinion of two people. The one person that bought it and the one person that sold it. And there's not even a consensus. I mean, they had conflicting opinions. One person thought it was a good idea to buy it, and the other person thought it was a good idea to sell it. So we can't really gather too much information from that most recent transaction. Okay. And even if we went back a year later and had 20/20 hindsight, we still couldn't gather that much information from that transaction. We could go back to those two participants in that transaction and we could ask them, which one of you won? Was that a good decision? Was that a bad decision? And it's possible that one of them said, yeah, I'm glad I did that. And the other one said, no, I shouldn't have done it. But it's also possible that they both determined with 20/20 hindsight vision that, hey, I'm glad I did that. The person selling may have owned that security for a long time and had a nice profit in it, and they realized a nice profit and they were happy with their transaction. Or maybe they're glad they got that money because they used it to buy something else that also did well. Or maybe they used that money to pay for their wife's cancer treatment and they're glad they did it. There's a multitude of reasons why the seller could have thought that was a great idea, and a multitude of reasons why the buyer could have said, you know what, I'm glad I bought that security. Since I bought it, it's gone up and I'm up 40% in the last year or whatever. So it's possible that they both could view it as a good decision. It's also possible that they could both view it as a bad decision, given a year's perspective in 20/20 hindsight. The person that sold it could have said, well, shoot, I shouldn't have sold it. They were a long-term investor and it was in the temporarily dipped, but then it kept going back up, and they might be kicking themselves and saying I shouldn't have sold it. And the person that bought it might have been a short-term trader and they had seen it on a dip and they said, man, I think this thing's going to bounce back, and they bought it and it continued to go down in the short term, and they sold it for a loss, and they might be kicking themselves and said I shouldn't have bought it. So even with hindsight, we're unsure if that transaction was going to be good for one and bad for the other, or good for both or bad for both. So we can't really gather too much from that most recent transaction. What I've been taught to do is to form my own opinion of the value of that company, to learn how to value a company and understand what the intrinsic value of a company is, form my own opinion of that company, and base my decisions on that, on my own educated opinion, not on the opinion of two random participants in the stock market on any particular day. So that's our approach to investing. It's worked well for us. It's worked well for the people that have taught me whether personally or through books or videos or instruction or classes. People like Benjamin Graham and Warren Buffett, Charlie Munger, Peter Lynch, Philip Fisher, just to name a few, and the list is long. But so I just wanted to give some perspective and on this hike, and I'm off to get to the top of the mountain. Okay, you guys have a great weekend.